moving. First rates any seconds now. It's not going to be a great start for benchmark indices because the handover is quite lull and dry. But look at the breadth. Hello, that is like the prime focus, which is 1127 versus 350 declining shares. So that's a ratio 1:4. One stock is going down, 4 stocks are going up, or 4 stock is going up, 1 stock is going down. Let me now start quickly addressing some of the newsmakers now. Not too many newsmakers, but in terms of the pharma, well, DVs came out with numbers yesterday during the bell. Indigo con call has gone very well, and Bharat Forge numbers came during the market hour, and everyone is calling it expensive. In terms of price action, well, everything was centered around Zomato. Everything was centered around how things are going to move, at least for the entire fintech space, and couple of upgrades and downgrades they both have kicked in for some of the fintech and consumer tech stocks. But I think that's the breadth of the market which continues to be formidable. It does not matter what the print on the Nifty is or the print on the bank Nifty is. What matters is that the breadth is seemingly positive in favor of the bulls. Aisha?
Yeah, that it is. A couple of positive takeaways from a Star Health. They've recovered slightly with that 18% growth in the month of October. For Nykaa as well, the GMV has seen a growth of about 25%, and the beauty and personal care segment revenues have come in higher by 19% and EBITDA jump up of about 32%. But I think there could be a little bit of a base effect as well at play over there. Nykaa holding up almost 4% higher this morning as we speak. Let's see what Bajaj Finance is up to. That QIP launch would be at play, although much in the news. It's only the pricing which is the new element here. 7609 for Bajaj Finance as we speak. Positive numbers from Imami. Positive numbers from HPCL as well, Gland Pharma, RR Kabel, Paris Defense, and even Radico Khaitan has come out with great set of numbers. Gland Pharma, by the way, has gapped up about almost 5% there. And you're seeing good reaction coming in on Paris Defense as well as RR Kabel as well. But then disappointing numbers coming in from an NHPC, from a V-Mart, VRL Logistics, Man Infra, and even Shobha Limited, wherein the margins have actually fallen quite a fair bit, 10.25% versus a comparable of 14.25%, and the EBITDA as well has seen a downtick of 20.5%. Similar is the case with the Reddington 2, wherein the EBITDA downtick stands at 9.6%. Margins also have slipped about 60 basis points. And Greenply Industries 2, wherein there is a margin squeeze and the profits are lower starkly by about 41%. So these are a bunch of stocks which are in focus. Let's check in on what Divi's and BOB both are up to. BOB after that downgrade, the downtick in the stock yesterday, and Divi's as well, wherein Jefferies has downgraded it to a hold from the earlier buy and cut the target price as well. That stock too starts off a little bit lukewarm in trade. There's a downgrade from Citi on sale too, from the earlier buy to now straight away sell. So look out for that stock as well. That's also going to be in focus. Kunal, along expected lines, consolidation, or do you think we could weaken further from here?
I think we should consolidate over here. So 50 points minus for the index for the Nifty and 150 down for the bank Nifty. Nothing much to take away unless there is major signs of the larger cap names starting to show signs of underperformance. Now, in terms of opening trade, ICICI Bank is something which looks attractive. The stock did pretty well yesterday, closing towards its 50 DMA. So that would be a stock which I'd be keen to buy, specifically once it breaks past above the 50 moving average.
Okay. What about you, CA Rudramurthy? What are the opening trades you are punching in?
See, for me, this consolidation and this small dip of about 50 points on Nifty has to be used as an opportunity to buy. We are in a clear uptrend, no shorting this market whatsoever. So for me, 2 stocks looks very, very good to buy at current level on the opening trade. One is Vedanta. This stock has made that strong bottom at around 215, 218 level from where we are getting bounce. So I am looking for target of 250 to come soon on Vedanta. Available in future, one can go long. And even Tata Communications looks good for me. This dip towards levels closer to 1,720, 730 is a great buying opportunity on Tata Communications. So a buy on Vedanta and Tata Com. Overall market, use this dip as a buying opportunity.
Rajiv Chakkar, Chief Investment Officer with PPFAS, joins us now to talk about markets and to talk about how he's investing in this environment. And I must just bring this point out for our viewers. It's been such a privilege tracking this scheme. It's got not a very long history in terms of in mutual fund presence. Very small beginnings. Started with an AUM of less than 500 crores. Today, I've been told that they're managing 20,000 crore. Single focus, just one equity scheme, little bit of diversification, and look at what they've achieved in terms of very simple principles. So Rajiv, it's so heartening. No, I mean, आपकी कहानी तो हमने देखी है. So nice to see that.
Thank you so much for the kind words, Rikuj.
It's what 20,000 crores now.
Equity scheme is 45,000.
Oh, I thought 20. My bad. 45,000 crore of equity, and you started in 2012.
30.
13, and you started with 100 crores.
Yeah, NFO was less than 100 crores, but overall within a short span, we were at 300 crores. That was the PMS AUM prior to the shift to the fund.
Saying that you've been a multi-bagger, right?
Yeah, you could say that.
Okay, great. So nice to hear that. So, a scheme which itself has become multi-bagger, let's talk about the next multi-baggers they are betting on. Let's keep multi-bagger only as a theme. Diwali hai, multi-bagger theme rakhte hain. Your schemes have become multi-bagger, which of the stocks have become multi-bagger, and which of the stocks which could become multi-bagger according to you?
So, sorry to be sharing some bad news in that sense. I don't have too many multi-bagger ideas to share. Firstly, as it is, we are not allowed to give stock recommendations, you know that, and it was a trick question from your side. But overall, I think we are coming out of a 20-year period of falling interest rates, and rates have started moving up globally, and there was a valuation creep overall. So all asset classes world over went up in valuation. So at a time when, let's say, US bond yields are around 4 to 5% and threatening to go higher and for longer, I don't think one should be really looking at hitting sixes right now. It's cricket season as well, apart from Diwali. I think people have made good amount of returns in the last few years. Not last 2 years, but maybe if you look at it from a 5-year perspective, I think it's time to be more conservative in terms of the future outlook. I don't think it's a time to be very, very aggressive in terms of investing.
Is it because of valuations? Is it because the way you think economy will evolve? Is it election risk? Why do you say that?
Sure. So I'm not talking about any event risk or macro. I'm not talking about the conflict in Israel or the conflict in Russia and Ukraine or elections and things like that. My thing is simple. See, for a very, very long time, fixed income investors were getting a raw deal. What they were doing is they were effectively subsidizing governments, and they were subsidizing corporate profits, the corporates who were borrowers. Now the tables have turned. We are in a positive real rate environment, and borrowers will have a pinch, whether it's a corporate borrowing money or whether it's a individual who has taken a mortgage loan on floating rate basis. We have seen EMIs going up. That will somewhere affect consumption down the road. That will affect things like real estate prices, real estate sales, auto sales. This is, I'm talking from a global context, developed world largely. So somewhere all these things will have an impact, and the gradual creep in valuations that we saw, it at the broad level, it may not seem expensive. So Nifty 21 multiple may not seem very, very expensive. But when you look at the individual company valuations, some trading at 70, 80, 100 times earnings, or some of the newer listings coming on, prospects of future profitability and just focusing on growth, I think that environment has changed, and one should be cautious on that front.
Holdings right now, they include names like ITC, Bajaj Holdings, ICICI Bank, HCL Tech. There is no pattern here. I mean, it's not that you've got very large concentrated bets in IT or pharma or financials. Has that been done on purpose, that you are not, in a sense, following the benchmark per se?
We have not been following the benchmark since day one. So from that perspective, it's nothing new. So we have said that we are an active fund. We will go where we see the opportunities, and we will not worry too much about what is the weight in the index at that point in time. So these names, some of these names have been around for a while now in our portfolio. So Bajaj Holdings has been there for long. ICICI Bank, HCL Tech has been there for long. So in post-COVID, we actually moved out from small and mid-cap IT to larger IT names. So that's where something like a HCL Tech finds position. ITC was a contrarian purchase a while back when people were not looking at it. It ran up quite significantly. So we have trimmed some weight over there. But otherwise, these names have been around for a while. Coal India would be a more recent addition in that sense.
Also wanted to get a sense from you into which sectors are you adding your weights? Is it those, underdogs, the likes of pharma sector where you are adding position or sticking with financials of the world?
I think almost any person that you get on the show, almost anyone from my colleagues in the fund management in the industry would say that banks are looking attractive in terms of the valuations that they are trading at and in terms of the clean balance sheets that they are having. The challenge that the fund managers are having is that banking as it is a large portion of the overall market cap and overall index. And any fund will not go overboard in just one sector. So to that extent, people are having to limit their exposure to the banking space. But I think banking is looking very, very attractive. You mentioned pharma. So pharma has not done well for last few years and valuations are looking attractive. And even on the business side, some of the challenges that they were facing are increasingly behind them. So that space is also looking interesting.
Rajiv, but the
Auto
thing
is
with
another space which is coming
Sure.
out of a long period of low growth or no growth kind of environment. That is one other space which is looking good.
Right. So let me pick up on each of those spaces one by one, Rajiv, because banking is getting pretty diversified. PSBs are chugging along in a different trajectory. ICICI Bank, of course, is in a different orbit, but I can't say the same about an HDFC Bank or a Kotak or many others as well. Where within banks is your tilt?
So to my mind, there are 5 banks in India, 4 in the private space and 1 in the public space, which have done well in terms of having a full range of product offering, having a good CASA share, having a well-diversified product portfolio, well-diversified branch network. So I think that is a space that we are looking at. Some of the banks that you mentioned where because of a reason where they have taken all the credit losses in the past and now they are not having to provision so much, they may be looking attractive in terms of price to book or price to earning basis. But the challenge is that many of them are ceding market share to the 5 players who really lead this space. So I would not go purely tactically in terms of looking at the current result numbers and investing in them for a short period of time. Really, these banks which are gaining market share are the banks where we are investing in. So we have 3 private sector banks in our portfolio, and that's where we are invested.
4% higher for DB Realty. They've sold Real Gem Buildings to Rustomjee Group. Now, DB Realty was this, it's a Mumbai-based real estate company. They ran into a lot of trouble. They've got a, unfortunately, if you look at the news and where DB Realty cross connections were with what happened 10 years ago in terms of the telecom scam, that is something which markets did not like. Are they on the comeback trail? Are they looking at revival their businesses? They're trying to rebuild the franchise, but let's see what happens. It's too early to pass on a verdict. By the way, in this company, I think 2 years ago, Rakesh Jhunwala had made an investment through a right issue or something. Rajiv, is it time to buy into real estate sector? The stocks have even done rather well, but this is a sector where RERA is at play. All the do number has become ek number, if I may use the word. Corporates, real estate companies are clean in terms of corporate governance now. And instead of dozens of real estate builders in India, now there are few big ones only left.
Nikunj, the bull case can be made at any time in the last decade or 2 decades, but the experience of public market investors has not been that great in this space. Uh, we watch it periodically, but we are not big fans of investing in this sector. And again, here, see, if you are buying a FMCG company, things move like clockwork. So if you are buying a soap manufacturer, you know that this much soap will be produced and sold, and this will be the kind of margin, and this is the ad spend, and that's about it. Here, you have to have a view on project by project basis. So just for example, a Mumbai-based real estate developer could be doing very, very well in the western suburbs, and then they may get stuck in uh, a project in mid Mumbai, and then what was looking hunky dory becomes suddenly very, very challenging. Then you have all these CRZ regulations, or sometimes some thing gets stuck in litigation and this and that. So we have been hearing consolidation and asset light model and unorganized to organize, all that we have been hearing for a while, but yeah, we'll probably give it a pass.
You've avoided, let's say, at least the portfolio which we have in public domain. You don't have high exposure to the so-called fashionable names, defense, power, railways. These are the so-called mega trends.
Sure. Uh, in fact, it's very interesting, Nikunj, that you asked this question. I just wrote a note on this to our unit holders for the forthcoming unit holders meeting, and we'll just release it in a couple of days. So the one line from the note goes like this: Benjamin Graham, more than 5 decades back, said, obvious prospects for physical growth do not translate into obvious profits for investors. Now, it's a very, very powerful line. And in the Indian context, if we go back in the past, in the early to mid 90s, two sunrise sectors, growth sectors would look like uh, private sector airlines and would look like the new mobile telephony companies that were launched at that point in time. And there was obviously hype around these sectors. And fast forward a few years, and those sectors did not really do too well for equity shareholders. So apart from volume growth and opening up of a sector or good tailwinds, what also matters is capital efficiency, management and promoter quality, how much leverage they are taking. Is it a very, very competitive sector or is there a scope for some pricing power? So all these things also have to be looked at in conjunction. So you are right. We are not participating in some of these fancied themes just blindly, and we are taking our time looking at the companies.
Sure. I think you've recently also reduced your weight, Raji, on the likes of Coal India, Power Grid, etc. Is it a tilt against the public sector entities, or is it that you think these are now overvalued and the power rally is pretty much factored in?
I would not read too much into the some small selling that you would have seen. So many times it's driven by the portfolio weights that we are looking at and things like that. So I would not read too much into it. But we continue owning these companies, and it is what it is. So sometimes, so again, this is public information. We do have this covered call strategy in some of these companies, and sometimes the sale may be purely a reflection of that.
IT, Rajiv, I understand that with power there might be a bit of a portfolio management there, but what's your structural call on IT?
I think near-term challenges are there, but broadly the space is one where the management quality is pristine. Again, they don't have too much borrowing. In fact, most of them are net cash companies. So we are looking at it beyond the current cyclical downturn. I think they will be back on the growth trajectory in a few years, and we are staying put for that, and we are staying invested in the IT space.
Rajiv, earlier you flagged off your preference towards autos as well. Again, diversified as the sector may be, what's the preference within autos?
I think the four-wheeler space looks interesting in autos. So while entry-level cars have not been doing too well, but the selling price per car has been going up, and again margins are improving, and those kind of things. So I think right now the mid to premium segment is doing better than the entry level vehicles, but soon enough you'll probably see demand coming back to the entry level as well. So four-wheeler space is where we are invested in.
Rajiv, great to have you on the show. Thank you so much for taking the time out, and here's wishing you a very happy Diwali from all of us.
Thank you so much, and happy Diwali to you and all the viewers.
Thank you so much. Okay, on that note, let's take a very quick break. We've stabilized for the market, and it seems like it's one of those quiet days. We're lingering a little bit in the red, but let's hope it doesn't get worse from here.
Welcome back. Well, while the secondary market is pretty much flat, 0.25% down, it's the primary market which is very, very lively, and one of the stocks which will get listed today, very, awaited in terms of its listing as well, and that's Mamaearth parent Honasa Consumer, which is likely to make the debut. While the overall market mood is somber, maybe we'll see a bit of a green when that stock lists. Let's go across to my colleague Vinny, who's standing right by to give us a sense as to what we should expect from this listing. Vinny?
Absolutely. So today is NASA's listing, and when you look at it, overall the subscription that they've gotten is around 7.61 times, while in terms of QIB also the subscription was almost 11.5 times the subscription they've gotten. So yes, good subscription data that has come in, strong subscription data. NASA was a company that was founded in 2016, and obviously is the parent company for Mamaearth as well, and they have other brands like Dr. Sheth, they have B Blunt as well as Mom Presso, some of the other brands that are there. Now in terms of overall, when you're looking at it, if the company lists at a issue price, then the market cap would be at around 10,400 crores, while if the company lists at a premium of around 10%, we would see a market cap of around 11,400 crores approximately, and a 30% premium would mean a 13,520 crore premium would be a market cap, would be the market cap of the company. Valuations is one bit of a concern that comes in, that at the issue price it would be around 10,400 crores. That's what investors are a bit worried about. But the if you look at it, FY24 forward PE, that's at around 100 times, so seems a bit expensive compared to other FMCG companies as well. Now the strength of the company, Mamaearth has seen a CAGR of 62% over the years as well. Mamaearth accounts for around 65% of their sales as well. It's going to be interesting to see what is the listing, but yes, market cap of 10,400 crore at the issue price is what it looks like.
Okay, all set for a premium to its issue price. We will take it across to Vinny once the listing as well takes place. But let's welcome on board Abhi Soi, the CMD at Max Healthcare Institute, joining in on the show right now. Abhi, hi, morning. You're undergoing a major capex currently, and every quarter a new facility is getting added as well, which I'm guessing will definitely push your OPEX too. How is it that you're managing to ensure resilient margin performance and the next 2 to 3 years? Where is it that you see your margins headed?
Look, I think if you actually see, this has been the 12th consecutive quarter of year-on-year growth that we've had, and the highest ever quarter. So it's been 12 consecutive quarters, and this only happens through extremely, I think, obsessive focus on execution. We continue to execute. We continue to generate numbers. We always guided to the fact that 85-90% of our total expansion is coming through brownfields, where the break-even is a matter of months, not a matter of years. And you get huge amount of operating leverage. And you've seen that with the newest brownfield, which was Shalimar Bagh. Previously, you've seen it with Vaishali Hospital brownfield that we've done. So, we will continue on the same trajectory. I think as far as the sector, we are today generating alpha amount of cash flows. As you see, we are a debt-free company now. We've added, but we have over 1,300 crores of net cash sitting on the books. we added about 430, 440 crores of free cash flow post capex, pre-capex, but post maintenance capex to our kitty this quarter itself. But at the same time, there's such a phenomenal opportunity, an attractive opportunity to invest in this sector. We can't imagine a better time to do so. So we're using all of that cash, and we hope to deploy it at very attractive terms within the sector and really embrace the opportunities that the sector is throwing up at this point in time. I mean, really, India and the sector both are once in a lifetime sort of story right now.
Okay, but I also wanted to discuss your occupancy levels because that's inched up to 77% in the quarter gone by. A, what has aided to this growth? And secondly, when the newer establishments do scale up, what kind of occupancy level should we expect then?
With respect to the occupancy levels, so you need to look at operations on a year-on-year basis, not on quarter-on-quarter basis. And our increase in number of occupied bed days has been 3% over same time last year. So it was pretty much in line with the expectations. And it's also in some part got to do with the seasonal effects, because this is the season when you have a lot more medical patients because of dengue and some of the other seasonal diseases. And therefore, I sort of always encourage occupancy numbers to be compared to same time last year. But in that respect, also it's been healthy. It's been an 3% increase in occupied bed days. With respect to the new facilities, with the new facility, which is Shalimar Bagh, collectively last quarter, the new beds and the old beds were operating at about a 78-79% occupancy level, and with EBITDA margins of about 38 to 40% from that facility. So it's ramped up very well.
Right. And last quarter, your ARPOB was also 5% of an increase in the total billing for the PSU contracts. You expect a revision coming in there?
Increase in the PSU because of increase in CGHS rates had an impact of about 14 crores on our EBITDA. 14 crores on our revenue in the last quarter, or in the present quarter, which we just passed. And we were expecting further increases in this quarter itself, which have not come through as yet. One hears they're still in the offing, and we are hoping it should come in the current quarter now.
Okay, and also give us an update in terms of the capex plans. What's the progress on the capacity additions that you had planned?
We've been having great progress on our ongoing plans. The one which will come up the soonest is the Dwarka Hospital, where the developer has now applied for occupation certificate. So we're quite hopeful before at the end of the financial year, we should have that set of operations started. Thereafter, Nanavati, which is Mumbai, is quite on stream. We're expecting that to come through by the end of next year. And so on and so forth. There were historically some delays as far as the Max Smart, which is the Saket project, is concerned. But that's also picked up speed. We finally got the approval for tree transplantation, etc., and that is in the works. So that's back on track now. We are looking at adding about 2,200 beds, I think, over the next 3 years. And all of it is pretty much online.
Right. Now, when it comes to post-care hospitals, what are the plans regarding if you would have any acquisitions, any segments or areas which you would currently be interested in?
Plenty of opportunities that we've been looking out for, and we continue to look out for. I'm quite hopeful in the very, very near future, we should be announcing some. There are all different opportunities, different projects in our pipeline, which are at different stages. It's not done till it's done. But we are quite hopeful. We should be, perhaps a series of them should be coming through, given the robustness of our pipeline.
Okay, so that point is taken, but a lot of hospitals are reporting better numbers due to improved payer mix as well. How do you see this trend shaping up in the industry?
So the international business has gone up. It's gone up by 25% compared to the same quarter last year. Collectively, it stands at about 9% of our revenues now. as far as the institutional business is concerned. If I look at ex-Shalimar Bagh, which is the expanded capacities come down, and if I compare apples to apples, the number was 28 or 29% last year. It's come down to about 25% of our total bed share. So there has been a reduction of 4%, and therefore it should continue gradually in the same light.
Right. Tell us a little bit about the growth plans that you may have in the lab segment.
So we've had in the lab segment a 32% increase year on year. We've had and a 15% quarter on quarter. So it's quite a healthy sort of increase. We are looking at some opportunities for acquisitions, etc. But these are smaller, more viable ones. But nevertheless, they've been very encouraging trends, throughout the last few quarters, where not only has the profitability increased, but also there's been a robust growth both on year on year and quarter on quarter basis. So, we feel quite good about the business.
Okay, Mr. Soy, on that note, we'll let you go. Appreciate you making time and speaking with ET now. Time for a short break on the show. But as we do that, just a quick check at the rates. 19,364 is where we are at. And the indicative price for Honasa is just a smidge above its issue price, 330 versus 324. So it's not a big blockbuster kind of, listing that we were expecting. A bit of subdued, but that's pretty much in tandem with what we are seeing with rest of the markets as well. Slipping into that very short break.
Back with first trades right here on ET Now. Here's Christopher Wood from Jefferies telling us what are the shares which are currently in the India portfolio, the themes that they've invested in.
I could easily have 40 stocks in my Indian portfolio.
So what do you think you wanted to add, you have not added?
Well, I have nothing in the auto sector right now. I have in the past. That's one obvious example. An area which did very well the last 2 years, which I was sort of familiar with, but I didn't put any money in there, was the defense sector. Then I could definitely have more in the power sector. I could have more in the engineering capital goods sector. Then I have almost nothing in the consumer sector. I have zero in IT services. Now, my three areas I've been playing right of late is financials, property, and what I would define as capex related. So if I wanted to focus, but I'm running this quite structurally, less tactically. So structurally, I've always had the private sector banks in my Asian portfolio. This Indian portfolio was only created more recently, but my Asia ex-Japan portfolio, which I've run, the Greed and Peer portfolio, which I've run since 2002. Yes. The one sector I always had representation since 2002 is Indian private sector banks.
And how has that portfolio done? What's been the return of that portfolio?
That portfolio has massively outperformed the benchmark, the Asia ex-Japan.
Okay. So
I haven't got the data in front of me.
In that portfolio, apart from private banks, what else do you have?
What? Oh, right now?
Right now?
No, right now I'm about 45% in India.
Vineet Bolinchkar, Head of Research with Ventura Security, joins us now to get a view on where Honasa or Mamaearth listing should list and what is a good time to buy. So Vineet, अच्छा है मगर महंगा है. Can I say that for Honasa?
अच्छा है पर महंगा है पर growth उससे और अच्छा है.
So what should
justify?
So what should one do? I mean, you can look at it and say, okay, it's a small business, but a very niche player. They've created a great brand. Growth is high. But if one is looking at buying it today, do you think in the future, future returns will be compromised, or at this price also for a 2-3 year view, it's a fair deal?
I think it is a fair deal, and I'll give a rationale for that. Is that the stock is justifying a growth of more than 30% in top line, and faster trajectory in the margins. And we have seen the margins pick up, 2% last year, 6% Q1. So the trend is definitely there that the path to profitability is being established. It's not established, it's being established. And we see drivers out there, and a brand which has grown in 5 years to be one of the largest brands. I think that definitely it makes sense to buy this stock. And offline portfolio, which is around 35%. Top three brands which are over 100 crores. So, your Mama Earth is 1400 crores. Your Derma company is 300 crores. Your the other brand is 150 crores, and the two new brands which they've acquired have got global appeal, and definitely they can easily grow them because they simply have to replicate the kind of work that they're doing. So, given all these expectations, I believe that the company offers a veritable play to enter the segment and buy into it. Additionally, if you see the global metrics are very strong. India has the highest growth rate, lowest penetration for the BPC space. Also on the e-commerce space, we are the one of the lowest penetrated and the fastest growing. So all these add up to a very stable, good portfolio, which should help enable the company grow very quickly. And to my mind, a 28 to 30% growth is not difficult, given the fact that it's a fledgling company in a large space which is growing very fast and has got excellent market recall.
But Vinith, is it the right price currently around the issue price to actually buy into I mean, how is it? What would you say is a fair value really for this business? While you do see growth in the longer run, what's the price you're willing to pay?
So I think I will buy at current valuations and add down lower. I'm not going the whole hog into the company right at the current price. But if the price does correct, I'm definitely going to step into the counter.
In fact, we are getting those live visuals as well from the NSE. Well, any minute the bell ringing is going to take place, and we will cut across to those visuals as well. But Vinith, what would you say is the closest competitor to the brands Honasa actually owns? Namely, of course, the more popular one being a Mama Earth. And how do the valuations stack up amongst the peer group, you would think?
Right now it's difficult to give a call purely on the numbers which are there, and I don't want to give you a metric purely based on the EV to sales because the dynamics can change as the profitability kinds of builds up. So I think 10,000 right now at this current pricing, it definitely looks very, very decent to get into the stock at current levels.
Vinith, some would say, look, I bought into Zomato because it was niche. Paytm was great because it was high growth and a very niche fintech, model. But with Honasa, A, it's in a competitive space. B, it's a space where incumbents have a far bigger reach and far bigger say. They managed to grow their balance sheet by having 35% of its revenue spent in advertising. So when it comes to competing with big boys, where balance sheets and reach is much stronger, can Honasa and Mama Earth really grow that well?
So, we have to just measure the pace of the growth of the brand by itself. So, what Dove did in 18 years, as they say in their report, Honasa has done it in 5 years, or Mama Earth as a 1,000 crore plus brand. So, definitely the brand is well known. It's a very, very premium brand. And there is an increasing tendency among the Uber Neo crowd to go and pick, concentrate stories which are very niche in nature. And to my mind, I think there is ample space for niche brands to exist and coexist with other players. And when you're going online, the difference between these two is obviously the traditional category of FMCG brands and the neo brands which are there is kind of obliterated. So you are on a equal footing with them as long as you are doing your spend as well. And while Honasa has been a digitally first enabled brand, their the retail part or the offline portfolio is also growing very fast. So it is almost 35%. So, they have been able to grow both their digital as well as the offline piece very well and continue to manage the growth. And, speaking about the gross margins at 72%, they are one of the best plays out there. So, with a high, despite the premium pricing, aggressive gross profit margins among all the other companies in the listed space, I think their path to profitability will be much faster.
All right. Listing, it's a big day for an entrepreneur. I mean, imagine a company which had very humble beginnings if it's going public, backed by P, and when you are listing, it's a big moment. I mean, for an entrepreneur, that's the ultimate dream, that you take a company public, bootstrap it, get it backed by private investors, then take it public and get endorsement in the public market. Is Ashish Chauhan there? Yes, he's there. Is it Shilpa Shetty?
Yeah, it is Shilpa Shetty.
Yeah.
She is one of the investors in her now.
So I had no
in
idea.
Mama Earth.
She is?
Yeah.
Okay. So I can see Shilpa Shetty, I can see the family, I mean the family in a sense, the husband and wife, and I think they are the children. But just imagine it's a homegrown company. It's a company which in a sense is giving competition to some of the biggest global brands, some of the legacy companies also. Legacy companies, when I say, all right, let the screen do all the talking.
And we begin, or rather we do this,
Achha, I thought you
in
didn't realize.
10, 9, 8, 7, 6, 5, 4, 3, 2, and 1! Woo! Everybody, can I hear you make some noise? Come on. Many, many congratulations to the entire NASA family.
It's a big moment, like I said, for an entrepreneur to see it go public, and then just happened, within a couple of years. And it's not easy. I mean, the entire so-called FMCG or the cosmetic market, India, it's not a very easy market because you've got the legacy players there, HUL, P&G, Godrej, who in a sense have a very strong foothold, reach, distribution and brands and recall. Honasa comes, moves into a category, backed by the spiel of Ayurveda natural, and then they go public and they've had a sizable market share. Now, the journey of how Honasa would move would be a function of growth, because markets are giving you this valuation only because you're a high growth company. If growth continues, then optically 3 years from now, the stock will look cheap. But if growth gets damaged, then this price is not going to sustain. So I cannot pass a verdict, अच्छा है, सस्ता है, but growth है. That is something I can say very, very decisively. You can see Shilpa Shetty, you can see the family, I think the children, the promoters there, husband and wife, P investors. I cannot spot any. Ashish Chauhan, good old Ashish Chauhan. Yeah, there you go. It's a big listing day, at least for Mama Earth or Honasa. Well, another company which joins us today is Bikaji, and they've also gone public. Not once upon a time. The brand is once upon a time. The legacy of the company is great, but they've just gone public barely 2.5, 3 years ago. Bikaji Foods post-listing has done rather well for itself. They've come out with numbers, and let's discuss those numbers. Manoj Verma, COO, and Rishabh Jain, CFO of Bikaji Food joins us. Manoj, Rishabh, good morning. Thank you for joining us. So Manoj bhai, Diwali कैसी जा रही है? Diwali कैसी जा रही है?
I think Diwali is going very good. There's a lot of excitement amongst, manufacturers, retailers, and consumers as well. So we are very excited.
When you say excited, can you define it for us? Is this Diwali better than last Diwali? Is this Diwali sales are going to be like never before?
I think one single line, if I can say about Bikaji at least, is that we are running out of our gifting stocks. I mean, we could not, meet the demand what we anticipated. I think that's a solace, or that's a strong thing we look at.
Rishabh, what we are discussing today are numbers for the quarter gone by. But that is the quarter of July, August, September. We are in November. And the following has happened after November, after September. Vegetable oil prices have gone higher. Food inflation selectively has made a comeback. And for the quarter gone by, if tomato was the problem, now onion and tomato, they both are a problem. So the margin expansion, what you've reported for the quarter gone by, will that get challenged in this quarter?
So, first of all, thank you. And So close to 1 year back, we got listed. So it's and I was seeing Mama listing. So it's an emotional moment for them as well as for us at that point of time. But yeah, so we have seen a good journey post listing. And from bottom line perspective, of course, we are looking at some increase in few commodity. But yeah, we are not consumer buyer of tomato and but edible oil is supporting. It's not going upward. But yeah, few pulses are in increasing trend. But yeah, it's in control, and we will be. We are not only working on but we are working on many efficiency level, be it purchase, hedging few commodity, building a lot of efficiency at below gross margin level. So yeah, we are working on we as a team we are working very hard on maintaining this gross margin and EBITDA level.
You will stick by with that 13% level for your gross margins?
So that's what our target is.
Okay, good to hear that. Tell me, what is the target contribution when it comes from, the snack segment and from the sweet segment? Because from what I understand, the sweet segment is currently 12% of the revenues. Do you see this getting bigger in the revenue pie eventually?
So we don't think that it will go as bigger because if you look at most of our expansion, the capacities what we are building across country are more on the snacktionary side, be it Western or ethnic. What we are trying to do is that how's that we can, bring up the value. So the premium sweets kind of our stuff is what teams are working on.
Manoj, when has the capacity expansion, when will it kick in? Because when we spoke to you last time, you said that you're almost at the end of the capacity expansion cycle.
So I think more or less it's over. So now it's one frozen unit, which is which in fact trials have already started, gonna get commissioned, as we said, the frozen plant, which is coming up in Bikaner, and one another unit which is coming up in Durg, right? With this, our expansion phase would be over. It is now then on the utilization part. But as I said, all expansion is being primarily into Western and ethnic snacks, not the sweets.
To bring you in the conversation as well, the last time we spoke, you were talking about a 20% kind of growth in FY24. But if I look at the trajectory so far in the first half of the year, it still continues to be in single digit. Are you still holding on to that target of 20% growth in the year?
See, we said something between, say, 15 to 20% kind of a growth, right? When we said that about 16-17% would be our volume growth, right? And then rest is a factor of that, what price increases and all that stuff. This in itself would be a historical change over last many, many years, wherein the value growth is being by far higher than what the volume growth is. So that's what we said. I think we are on track. We should be close to what we have committed or what we are working on. Only thing is that when you look at first half, wherein the play of Q2 and Q3 is very, very huge, and I think in our last conversation also we pointed out that there's a shift of gifting. So the kind of growth what you will see in Q3 will be much higher than what was in Q2 because of sweets shifting here. That's perhaps is the reason why this number is looking single digit, but will turn around.
Margin picture, because the raw material prices have come off, whether it's wheat, whether it's edible oil, things are looking like they're on the mend as far as raw material prices are concerned. What about the margins going forward? Because it's been sticky around the 13% range for the last few quarters.
Yeah, so this quarter we have EBITDA margin is close to 14.2%. That's what our target is. Our target is to be in between 13 to 14%. That's our target is, and we are on track on this. And one more point, that from volume growth perspective, what we told earlier also, our volume growth in salty snacks category is upward of 17%, and that's what we have done in the highest in last many quarters. So in this 2 quarter H1 24, our volume growth is upward of 17% in salty snacks category. That's what our target is.
Great to have you, both of you, on the show, and thanks for taking the time out and joining in today to highlight how Bikaji Foods' earnings performance has been and what's it looking like going forward. But now time for an ET Now exclusive, and this time around the company in focus is Cipla, what it means for the stake sale, which has been much talked about. We're picking up some exclusive info on that. In fact, Cheryl D'Souza from our desk is here to tell us about what she's picking up from her sources.
That's right, Aisha. We are picking up the fact that our sources have told us that the trading window for the employees has actually reopened from today. Why is this significant? Because this particular trading window for the employees was halted since the month of August, and this was actually since the first talks of stake sale actually began. So since then, you had the trading window for the employees that was shut, but it has reopened from today onwards. And also, this is a clear indication that for now, at least, the Cipla stake sale deal could be on the back burner. Remember, ET now has been reporting since October 9th itself that there has been some sort of a delay or kind of a back burner where this particular stake sale deal may have been put in on back of valuation concerns. In fact, we actually wrote to the Cipla management to get some more clarity on this particular development, and they've responded, and I quote, they've said that we confirm that the trading window for employees is opened today. This is what the Cipla management actually responded to ET now, and it's a significant development coming in for the fact that you had the stake sale talks being underway. We've been reporting constantly that for now looks like the stake sale, Cipla stake sale likely could be on the back burner on back of valuation concerns. And today this particular development that's come about is the fact that the trading window for the employees has reopened. Remember, it has been shut from August. So yes, a significant development coming in with that regard.
Address some buzzing stocks as well. That's what you're picking up on Cipla. In fact, we should bring up Torrent Pharma as well and show you how the stock is reacting to the news flow. But Kunal, let's take it across to you as well. Any chartbuster that you're spotting in an otherwise quiet market?
Yeah, I think Poonawalla FinCorp is something which has come back towards a very strong support zone in terms of technical chart structure. So this is the charts over the last 2 years. This red line which you can see is the 200-day moving average. And we've seen that over the last 2 years, there have been multiple occasions where the stock has gone through a correction. And the correction somehow has halted just around this 200 DMA, which has acted as a major support for the stock price. This also coincides with the fact that on the indicators, that's on the RSI gets into the oversold territory. So we've seen this was in 2022 start when the stock was almost at 200 to 25 zone. The stock took multiple support at this 200 DMA as well as oversold nature of indicators. This was in end of 2022 when the stock had retested the 200-day moving average, and then from here the stock bounced back and got into a very strong uptrend. This was in mid of 2023 where the stock was almost at 250 levels, and currently the stock, which is almost at the 350 mark, has again done a very similar kind of a chart retracement, retraced back towards its 200-day moving average. The indicators entering into the oversold territory. So this makes the trade and the risk reward attractive over here for medium-term investors. If you look at the previous instances, we've seen at least a 10 to 15% upside into the stock price. So from this 350 odd levels, we could be looking at 400 as a nominal target for the stock over the next 3 odd months.
Right, and Kunal, any individual stocks you're recommending?
So two buy calls. Piramal Pharma is something which is popping up on the charts, almost a V-shaped recovery for the stock, trading about 110 levels. So would suggest a buy with 122 as a target, stop loss at 108. And PNB is the other stock which I would recommend as a buy. Did the same yesterday as well. Targets of 82 for the stock and stop loss at 70.
Okay, point taken. So PNB is the other one on the radar. Just wanted to flag out a few more pharma stocks. So apart from Gland Pharma, which is a result reaction and higher by 6%, Piramal Pharma too continues to trend higher, 115 thereabouts. So that stock, after of course the good set of numbers and the turnaround that we saw, is in focus. Quest Corp is the other result reaction, as is the case with Indocount as well as RR Kabul as well. Tata Elxsi is the other one. No specific news flow, but that stock is high by around 4%, so let's watch out for that. On the losing side, it is Fusion Micro, which is down 4%. Angel One, you got the data out, the monthly update came out and it didn't look very impressive, I think, and that's the reason that stock is down 3 to 4%. And Sobha, as we pointed out, the margin miss is something that the street did not like. Before we head into the break, let's quickly bring up the stock price of Honasa yet again, because there has been a bit of a dip since its listing. So it wasn't a great listing to begin with, and since then I think it's still around the 329 mark, off the highest point I think of the trading session, because the discovered price was around 330. But taking that short break, don't go anywhere.